Hello and welcome. We'll begin momentarily. Hello, if you're joining us, we will begin in about 2 minutes. We're just gonna give everybody a chance to join here. All right, we'll give it about another minute here to give people a chance to join. All right. Well, we'll go ahead and get started and let people join here as we do our introductions. Hello and welcome everyone. My name is Leah Strevel. I am the events manager here at Inova Payroll. Inova Payroll is a national employer solutions company headquartered in Nashville, Tennessee, with 11 offices throughout the U.S. And Inova provides a full portfolio of payroll and HR services, including HR outsourcing and employer benefits. To learn more, please visit our website, inovapayroll.com. For attending today's 1-hour webinar, you'll receive SHRM and NASBA credit. You can expect to receive your certificate as well as a recording early next week. During the webinar, please feel free to submit any questions to the Q&A widget at the bottom of your screen. We will get to as many questions as we can, and anything we can't get to, we'll follow up with you afterwards. To introduce today's speaker, we have John Thompson, Vice President of Business Development at Inova. John?
Thanks, Leah. Can you hear me? Yeah, okay. Sorry, I'm pleased to introduce our guest speaker, Richard Phillips, who's the CEO and founding principal of ERISA Consultants. Richard brings over 30 years experience to the effective design, consulting, and management of 401k plans. He holds a Bachelor's of Science in Business Administration with a concentration in banking and finance. Richard's an enrolled agent, admitted to practice before the IRS, and an accredited investment fiduciary who adheres to a strict interpretation of a fiduciary. He's a certified pension consultant, qualified administrator, and is also a member of the American Retirement Association. He has contributed case studies for the American Law Institute, American Bar Association's Advanced Pension Program. He has also provided continuing education programs for CPA groups and has lectured on plan design techniques for medical groups at the RBMA Education Conference. Prior to becoming co-chair of the Retirement Plan Academy, he led a team to revise and update the investment curriculum of the Certified Pension Consultant Program. He's chaired the committee tasked with revamping the curriculum of the Qualified Plan Financial Consultant Program, which is a high-level training program for advisors working in the qualified plan arena. That's quite the mouthful of degrees and certifications there, so I'm very much pleased to introduce Richard and turn the floor over to him. Take it away, Richard.
Thanks, John. First of all, welcome to today's webinar. And today we're going to explore the use of pooled employer plans, also known as PEPs, and to eliminate 401k audit requirement. And for CE purposes, there'll be a few poll questions during the presentation. As you're probably aware, large plans, which we'll define a little bit later, are required to have an annual audit by an independent CPA. The audit must be attached to IRS Form 5500 when it's submitted to the Department of Labor and IRS. One thing I want to keep in mind here is, and the reason for this presentation today is to talk about specifically, a lot of times employers, smaller employers, are tasked with this burden of an audit. And we'll talk about some of the reasons, the history behind it, and why they're necessary. But I first of all, just want to make sure that everyone understands that we're not trying to circumvent a process. There is an important role, but especially for small employers, we want to try to make sure that we give that they're informed, they have every option and tool available so that they can, instead of paying for some things that may not be necessary, that they can reallocate those resources to their employees to make sure that they're on track for retirement or utilize a retirement plan to what's important for them. So just a little bit of context around that. So let's see. There are two government agencies tasked with regulating retirement plans in the U.S. The first one is the IRS. The IRS is responsible for tax qualification. And if the plan is qualified, that means that contributions and investment earnings are tax exempt from current income. And if by chance the plan is disqualified, then 100% of the account balance, contributions, earnings is immediately taxable to all participants. Needless to say, that's not something that we want our clients or anyone that has a qualified plan to be subject to. So there's quite a few regulations and so forth that go along with that, but the IRS is responsible for the tax qualification. And then the U.S. Department of Labor is tasked with enforcing ERISA. ERISA is the Employee Retirement Income Security Act of 1974. We're fortunate enough to, on the domain ERISA.com, you'd be surprised the number of calls that we get. We've even had folks from the DOL refer employees over to us. So we're not a government agency. We're a private organization that works in the retirement plan space for private pension systems. So to fully understand the rationale behind the audit requirement and its intended purposes, it's important to take a step back and look at the history of MEPs, PEPs, and 401k plans and some of the regulatory landscape that has developed. In 1875, American Express established the first retirement plan in the U.S. Until I started researching this several years ago, I had no idea that we went back that far. And then in 1942, so keep in mind from 1875 to 1942, those retirement plan arrangements were unregulated. They were not regulated by the Department of Labor or the IRS. And then in 1942, the Internal Revenue Service adopted, it was actually passed by Congress, but it was a Revenue Act of 1942, which then started regulating retirement plans in the US. And then in 1954, that was the first time the regulations came into being for multiple employer plans, also known as MEPs. So there was a big change to the industry in 1954. And then we had really a catastrophic event in 1963, December of 1963. The Studebaker-Packard Company, which was an automobile manufacturer, one of the largest in the US, they ceased operations. They shut their plants down, and a little over 4,000 employees, hourly employees, lost all of their retirement savings. Those who were retirement age got about 15 cents on the dollar. Everybody that was more than 5 years from retirement lost everything. So needless to say, it was an incredible shock. And keeping in mind before that, there was no regulations to protect employee benefits and look out for their best interest. And then it actually took 10 years for there to be enough political momentum. Some of this was driven by labor unions and different parties in interest, but it took until 1974 before Congress passed ERISA, which is the Employee Retirement Income Security Act of 1974. Gerald Ford signed it into law Labor Day, September 1974. So it was roughly 10 years from the collapse of the largest pension plan in the US until there was regulations around it intended to protect employees and their benefits. And then in 1978, there was another monumental change, and that was with the Revenue Act of 1978, which brought 401k plans into the IRS code. In fact, it's referred to as Section 1 401k because that's the Internal Revenue Code section that it relates to. And then in 2021, the IRS, through the Secure Act, brought into play PEPs, pooled employer plans were added to the Internal Revenue Code. So basically, there was a span of 67 years after MEPs were first codified before there were any significant changes which came about with Section 413E and built on the principles of MEPS and basically codified pooled employer plans. And it also defined pool plan providers. That'll be one of the other terms that we talk about today, is a pool plan provider. So 67 years from the time that MEPS first came about until PEPs were later adopted, which address some of the shortfalls that exist. So in 1942, when the IRS first started regulating retirement plans, keep in mind, this is 1942, there are no computers. Accounting was done manually. Ledger books, legal documents were typed out on a typewriter. So just to kind of put it in context, the basic plan document adoption agreement, the SPD, the document and the notices and so forth that we deal with anytime that a new plan is set up is roughly about 200 pages. So needless to say, every time a plan was set up and you had to have somebody type out 200 pages of documents and then also keep up with the accounting manually, there was a lot of costs that came along with that. And that was really what led to the rise of MEPS in 1954, was to give essentially smaller employers the opportunity to pool their resources together with other companies, so it spreads out some of that cost, so it's not borne by each individual adopting employer. But part of this, and the Treasury mitigated some of these issues, like I said, by allowing employers to pool resources together. But while it was a great solution, there was also some pitfalls with that. And one of the major pitfalls was the fact that if there's one bad apple in the group, it can really taint the entire group. So if you had 100 adopting employers, and if one of them filed bankruptcy, had some shenanigans going on with some investments or whatever, it could taint the entire group. So that was a significant shortfall. And then if one of the adopting employers got into trouble financially and made some bad investment decisions, some of those things could have ripple effects throughout the multiple employer plan. So quarantining those issues would have been ideal. But keeping in mind, we didn't have regulations to help mitigate this for the next 67 years. And then, like I mentioned a few minutes ago, 401k plans came into being in 1978 through the Revenue Act of 1978. Prior to that, all retirement plan contributions were made by the employer. So the Act added Section 401k to the Internal Revenue Code, and for the first time allowed employees to elect to have a portion of their pay directed from the employer's into the employer's retirement plan. Keep in mind also, even though an employee is making an election, those are still considered employer contributions. One of the things, if you dig into the IRS regulations, and one of the reasons things get kind of complicated, is a lot of times they seldom ever repeal anything, they just add to it. So that's one of the things that the Revenue Act of 1978 did, is they just built on the existing foundation of qualified plans, and where the 401k contributions, the employee is permitting the employer to reduce their pay by the 401k contribution. And then we come to PEPs, Pooled Employer Plan. And like I mentioned, it came about with the Secure Act, which in that Congress addressed a number of things, but specifically with MEPS, it addressed the substantial pitfalls that we had talked about earlier. So 67 years since the introduction of MEPS, the pooled employer plan provision really expands the opportunity for employers so they can adopt an enterprise level arrangement without bearing the risk of one bad apple or investments that may be inappropriate, tainting the entire group. So essentially what 413E did is carved out, and if you look at the regulation, it's about 1.5 pages long, so it's not very long at all. And like I said, it builds on most of the other regulations that's in the Internal Revenue Code. But what it does is it separates each adopting employer. They're responsible for their own contributions. They're responsible for their own investments. So if you have one bad apple or some bad investments, it's not going to taint the entire group. And that's really the most significant difference between a MEP and a PEP is simply those two significant pitfalls were quarantined, and now it's that risk is borne by each adopting employer and not as not a part of all the employers collectively. So what's the purpose of an audit? The culmination of these historical events have highlighted the importance of accountability. And that's really one of the things that we've noticed over the years is, especially with small plans, it's hard to maintain some of the resources and so forth that are necessary if you have a business owner that's wearing a lot of hats, or if you have, if you don't have the enterprise depth of expertise in-house to address some of the things and accounting procedures and so forth that need to be in place. So the accountability is really one of the most important functions and the purpose of having an audit, because it's attempting to ensure that the plan and the employer is in compliance with the standards of ERISA. And then in addition to that, an audit, whether it be a 401k plan or any type of financial audit, is really attempting to identify the misappropriation of plan assets. Let me clarify what that means. That can be intentional or unintentional misappropriation of assets. So the most common of which really is a delay in the remittance of employer contributions to the plan's trust account, keeping in mind that employee deferrals or employer contributions at its employer assets. And the same thing goes with participant loan payments as well. So it's intended to, the audit is intended to make sure that procedures are in place, they're being reviewed, so that we're not ending up with prohibited transactions where the business, the plan sponsor, or the employer is unintentionally holding some of those assets, or even intentionally, we've seen some cases around that, where they're intentionally holding assets to fund their business operations. So to recap, the audit helps ensure that the compliance gives regulators, and regulators I mean by the Department of Labor, some of the insight that they need for future regulations to craft around for basically any adopting employer. Over the past several years, the DOL has really improved, really increased their audit procedures. They're even auditing the auditors, and it's a very rigorous process. So the IRS has taken, the Department of Labor has taken a position that it's better for them to audit the auditor than it is for them to audit each individual plan that's already had a plan audit. But at the end of the day, the Department of Labor and the IRS is really intended to make sure that contributions go in, whether it be employee deferral, employer contributions, are really held and they're protected for the benefit of participants in the future. So that is the sole purpose of the audit, is to ensure accountability for the public good. So first poll question, are employee elective deferrals pre-tax and Roth, are those employer contributions or are they employee contributions? All right, I'm assuming everyone is marked an answer. So we'll, as I mentioned earlier, those are all pre-tax and Roth contributions. Employee elective deferrals are employer contributions. So even though an employee is making an election to defer out of their paycheck. So all right, so now let's talk about some of the, look at some of the strategies to eliminate the annual audit. We firmly believe that any strategy to eliminate an annual audit requirement should only be utilized if, and this is a big if the plan sponsor has appropriate checks and balances to ensure compliance with all aspects of ERISA and the Internal Revenue Code, and there are internal controls to monitor contributions and trust reconciliation. So, and what we mean here is, are there accounting procedures in place to look at the general ledger, an accounting department that can monitor what those liabilities are? the liabilities, processed through payroll. So there needs to, before we would go into, trying to eliminate an audit for a plan sponsor, we want to make sure that there's adequate controls. And we actually use the checklist, the IRS checklist, audit checklist, to ensure that there's adequate procedures and so forth, and document that process as well. So this is very, very critical. Is it required? No. Is it best practice? Yes, because we just want to make sure that nothing is being overlooked. So let's talk about the audit threshold. So a small plan, so the audit threshold is defined in 3 different categories. A small plan means that there is less than 100 participants on the first day of the plan year. A large plan is going to be one where it's 100 participants or more on the first day of the plan year. And then the interesting one is it's bigger than small, but smaller than large. And that's where there's 80 to 120 participants on the first day of each plan year. And that's one where we end up in a situation, let's say that there was more than 120 at one point. If it falls down below 120, you're still a large plan filer, but if it drops below 100 for one plan year, then you have the option of electing to file as a small plan filer, which would be IRS Form 5500 SF. And if you file as a small plan filer, you're not required to attach an audit. So it gives adopting employers a little bit of latitude there, sometimes because headcount fluctuates, especially the recession that we saw 08, 09, we could see the headcount fluctuate quite a bit. So it gives employers a little bit of latitude over, so they're not having to do an audit one year and not do it the next year. So it's a little bit of a wiggle room there. So, so who is a participant? A participant or beneficial participant is anyone who has a balance in the retirement plan or who is eligible to benefit under the plan. This includes employees who are eligible for the 401k plan, or even if it's a profit sharing plan only, who are eligible but have not elected to participate if it's a 401k plan. Even though they're not making contributions, if they're eligible for the 401k plan, they are a participant. This seems to be a little bit of a source of misunderstanding because we get inquiries all the time. Well, our head count can't be 150. We only have 30 people with an account balance. Well, it's who's eligible on the first day of the year. That determines who is a participant, not whether or not they're participating in the plan. So one of the strategies, one of the first strategies that we look at is really we're relying on Internal Revenue Code section 410B. So let's take a little bit deeper dive down in the weeds here. And some of this gets a little bit granular. So it's really more or less intended to be general education and general insight as to some of the strategies and so forth that you can do. We're not going to get deep into the mathematics of how this process works, how you define some of the groups and classifications and so forth in the Internal Revenue Code. But the coverage requirements are found in section 410B. This was actually part of the Revenue Act of 1942, but it mandates that all benefit plans cover at least 70% of the percentage of highly compensated employees that benefit under the plan. So for an example, if we have 2 highly comped employees, and a highly comped employee is anyone that owns more than 5% of the company, or in the look back year, so the look back year for 2022 is going to be 2021. So did anyone have compensation greater than $135,000 in 2021? If so, they're highly compensated in 22. So if we have 2 highly comped employees, 10 staff employees, but if one of the highly comps are excluded, then we're only covering 50% of them. So that means that we only have to include 35% of our staff employees. 50% of 70% is 35%. So only 35% of the staff must be included. Well, we can't do a half a person, but so we'd have to round up to 4. So in the scenario, we would only, out of a group of 10 staff employees, we would only have to include 4 of them in the plan. So So why would we want to do that? Well, it really depends on the facts and circumstances, but if we've determined, looking at the census data year over year, contribution rates and so forth, if there's a group of employees that traditionally have high turnover for that group, and if, a lot of times if they don't participate in the plan, we're not an advocate of taking anything away from anyone that sees it as a benefit. But if the group doesn't constitute that group that we've identified is very transitional, doesn't participate in the plan, doesn't see it as a benefit, then let's look at carving them out and excluding them. And we can do that under section 410B, as long as they do not constitute more than 30% of the workforce or the adjusted amount based on the number of highly comp employees that are participating in the plan. So essentially excluding them gets them out of the head count. So one way to go about this is to, and one of the things that we encourage clients to do in our intake is to consider breaking the employees into three different groups. The basic groups are Group A as owner and C-suite executives. Group B are key employees, which a lot of times can be general managers, supervisors, etc. And then Group C is all other employees who are not in Group A and B. So identifying breaking employee groups like this, a lot of times can help them identify, okay, we see a pattern in Group C, our transitional employees, that we have a lot of turnover. They're not opting to participate in the plan. So that would be one of the first places that we could look at, is carving them out, excluding them from the plan. So, and this can also establish a basis for employer contributions, which we'll talk about in a couple of minutes as well. And then strategy 2 is essentially building on some of what we've talked about already, but at least on that concept of it, but where this is where we're dividing employees up, where we're applying different eligibility requirements. So essentially some disparity in the eligibility requirements. And say if we wanted to look at our employee base and simply divide them up on salary employees and hourly employees. This is a very common way that employers look at their employee base. But if we do that, then we can identify, okay, our salary employees, we're looking at them as a group, we're looking at our hourly employees as a group. And then if we, and a lot of times we see this, especially in the hospitality industry, where they may offer, a lot of the employees in the group are, hourly staff, for instance. The hourly staff, a lot of times are going to have lower participation, but if the 401k plan allows for an employee to enter after 3 months of service, if we see that the head count is getting up really high, then we may want to consider discussing it with the employer. Have you considered maybe making your the eligibility requirements for your key employees, your managers, supervisors, general managers of the property or whatever, let them in after 3 months of service, but your hourly employees where they have to be there for a year. A lot of times that can reduce the head count because you have so much turnover. So there's a number of combinations that can be used. So the decision should not be made in a vacuum, but it should be something that's integral to the employer's strategic business objective. And just another strategy of how we can do that, where we're looking at salary employees, maybe use 3 months of service, and then, like I said, hourly employees subject to 1 year statutory requirement. And then a third strategy is split into multiple plans. Prior to the introduction of PEPs in 2021, splitting into multiple plans was really our go-to strategy because it opens the door from a plan design standpoint. So we have more flexibility on designing different levels of contributions for different employee groups that would otherwise not be available. So with this strategy, we essentially split participants based on years of service. That's one of the examples that a lot of times we do. So employers may say, okay, we want to take our longer service employees, 5 years of service or more, and reward them with the longevity. So essentially, it's like a longevity. Sometimes it can be extra contributions, but essentially, where they're carved out into a standalone plan by themselves. And then those employees that have less than 5 years of service, the benefits for that group may differ. So we have two different plans, sometimes have different levels of contributions. And as long as we can satisfy the coverage requirements, so we're making sure that we still pass 410B and then we have the non-discrimination requirements of Section 401A4. But those are things that we know going in. So we only split up a plan and use this strategy if there's differences in benefits, if we know that with an extremely high level of confidence, we can pass all of our coverage tests. But even if you kept both of the provisions, each plan, the provisions are the same in each one, you can simply just split them up based on some reasonable business criteria and still sidestep the audit requirement every year. And then the next strategy is, and really kind of the gist of our conversation today is really around using a MAP or a PEP. So with this strategy, if you take a standalone 401k plan and you're getting close to the audit threshold, you can merge your standalone plan into a MAP or into a PEP, either one. If the strategy is simply to lower cost and make sure that you mitigate any potential audit cost as possible. In addition to that, when you're doing the merger, it's a great opportunity to review the plan design and see if there's some ways that you can improve the plan design there as well. If plan design is not a consideration, then simply split the employees between a standalone, if plan design is a consideration, then look at maybe having part of the employees in a standalone plan, the existing plan that you have, carve the other employee, part of the employee base out that goes into the MAP or the PEP. MAPs and PEPs, one of the things to be very much aware of is some of the hidden audit costs. PEPs are fairly new, and one of the things that we've seen is with some service providers, and in fact, to give a little bit of context, a PEP is not subject to an audit unless it has more than 1,000 participants, or if there's an adopting employer, a single adopting employer in there that has more than 100 participants. If either of those events occur, then the PEP is going to be subject to an audit. So as you explore PEP opportunities as a solution for your company in its retirement plan, be aware of some of the hidden costs, the add-on cost. Make sure you read the service agreements. And is it passed on to participants through some asset-based fee or otherwise? So just a number of things to be aware of as you're evaluating those arrangements. So poll question. When is an employer considered a large plan filer? Is it when 100 or more participants or more than 120 participants? And that's the number of participants on the first day of the plan year. All right, hopefully everyone's got their poll question in. And all right, so basically a large plan is any plan that has more than 100 participants on the first day of the plan year. That's considered a large plan filer, and it must have an audit attached to it when it files IRS Form 5500. But also keep in mind that it can be 120 participants as well. So bearing in mind the threshold that can fluctuate between 80 and 120 is referred to as the 80-120 rule. So just a little bit of context around that sometimes that can change slightly. So moving on to the next part of our discussion today is a roadmap to the optimal plan, PEP solution. And there's really a lot of good content here. And this is really what I want to make sure that everyone sets up and focuses on, because it's conceptually, it's just a lot of great content. In my opinion, I get a little bit nerdy about some of this sometimes, but and this is driven really from the conversations that we have daily with our clients, with prospects, and trying to identify what's important to them. Because I mean, at the end of the day, that's really all that matters, is what's important to you, what's important for your business, and how all of this fits together. So it's been our observation that that the most important fact, a lot of times overlooked step in the building out a retirement plan is this simple question is, what's important to the business? Is there a strategic business objective that's been identified? And like I mentioned in our initial interview with a prospective client, and then also in our annual review with a client, we're always asking them to rank these in the order of importance to them today, knowing that circumstances change, the environment changes. I mean, I'm talking about the labor market changes, business opportunities change, economic conditions change. So a lot of things are constantly changing. So this is something that we want to revisit every year. And that's the reason that we ask a question. What's your objective? Is it to recruit and retain key talent? Or is it to facilitate retirement readiness for your employees? Or are you looking for some type of executive compensation arrangement, which is typically larger tax deductions for the owner and executives? So over the past few years, we've seen, it used to be, I guess probably 4, maybe 5 years ago, a lot of this was really driven around retirement readiness. And in smaller companies, it was really around larger tax deductions. And we actually saw this change through some of the COVID situation where companies were getting assistance and so forth. A lot of companies got money that they didn't necessarily need, so the business owners were looking for tax deductions. So we see these the order of this change periodically, but now it seems like everybody is really competing for labor. So recruit and retain employees has really risen to the top, and I would say about 98% of the time that's first and foremost what we're seeing the trend these days. So one of the things about recruiting, retaining employees, it's not just a matter of offering a 401k plan because everybody else, your competitor down the street does, but how do you use the plan to really retain those key employees that you're after? There's been some recent studies that indicate that employee turnover, so anytime that you have an employee that leaves for whatever reason and you have to replace them, it's roughly about 20% of that employee's pay. That's the cost of turnover. That's not even counting a recruiter. If you add a recruiter, it can be up to 35-40%. So the cost can get substantial. And we feel like that's where it's an opportunity to establish a strategic business objective when you're looking at your retirement plan, because if the goal is to recruit and retain key talent and you're not utilizing your plan for that, then what have you accomplished? You've got to have some way of holding on to those employees, and then also carving out benefits. And this is where, sometimes we see that, the benefits for, salary employees may be slightly higher than it is for hourly employees, just simply because there's a gap that's not necessarily being covered by Social Security, or it's a way that they're looking to recruit, maybe hold on to, some of the key talent that they otherwise wouldn't have, be a little bit more challenged. So now that we've established the principal reason for having a plan in the first place, let's build on that business objective. And essentially what we want to do is we want to build a plan around that strategic business objective. This is not a one and done. It should be reevaluated periodically so that the plan is always in sync with the stated business objective. If the business objective changes, then the plan design needs to change. Sometimes that means changing service provider. Sometimes that means restructuring the plan altogether. If a plan is safe harbor, a lot of those changes you cannot implement until the first day of the next plan year. So sometimes there are some restrictions. So be mindful of those. But really, at the end of the day, the most important thing is to make sure that the plan is aligned with the strategic business objective. So using this framework really provides a good structure for the decision-making process and establishes a basis for the plan design and the benefit formulas. So why is that important? Well, it's worth noting that as an employee's pay goes up, their Social Security benefits as a percentage of their compensation goes down. So for this reason, it's important a lot of times to look at the benefit formula. So if you have employees making $35,000-$40,000 a year, a 3% employer matching contribution is probably going to be adequate for those employees to retire at age 65 at 70% of pay. If you've got somebody that's in the, 80,000, plus range, the contribution, employer contribution, ideally needs to be somewhere in the 6 to 7% range. So using a retirement plan is a great vehicle and tool to build around those business objectives. So we've really found that this is helpful for employers that are really trying to come up with a strategy. And the thing about it, it creates a blueprint that you can follow year over year. So you're not having to kind of rewrap your head around this. It's a structured process that you can use every year to build on from one year to the next. One of the other things that, while we're talking about building around this and understanding that compensation, especially in this day environment, trying to recruit and retain employees is critical. Total compensation reporting, in our opinion, is really invaluable. And what do we mean by that? So total compensation reporting is really an effective tool that, so essentially what you're doing is you're customizing, you're building out a compensation report that takes into consideration all of the compensation elements that you have. When my oldest daughter was in high school, she worked at Kroger part-time. Believe it or not, they sent her a compensation report to a part-time high school employee, breaking down, this is how much Kroger put in for Social Security, Medicare, this how much went in for pension, all of those details. I mean, it was line by line for a part-time employee at Kroger. So there's a lot of utility in this. And it's not uncommon for benefits. In fact, if you look just at Social Security, Medicare alone, the employer portion of that is 7.65% of pay. So if you put that as a line item on a compensation report, in addition to everything else that may be provided, a lot of times it's 20% of an employee's overall compensation. So it's important, especially in this environment, for them to see that total compensation number and know what they're dealing with. Because a lot of times it's, 25 cents an hour, may be attractive, but oh, by the way, you're giving up all these other benefits that you're going to have to pay for. So compensation reporting is very valuable, and it is just another little side simple reporting that can be done. A lot of times, payroll systems can actually generate that as well. So don't miss out on an opportunity to constantly report that, at least on an annual basis, to your employees. So moving into one of the other arenas that we need to be aware of, we're talking about any type of qualified plan, but it's even more important to talk about it in the context of pooled employer plan and multiple employer plan. So there are always fees and expenses associated with an employer-sponsored retirement plan. Some of those fees are obvious, and some not so much. In fact, if you read some of the disclosures from your providers, you'll see things referenced to ERISA Section 408B2. That's a disclosure to the adopting employer. ERISA 404A5 is disclosures to the participants. So essentially, what we mean by a fiduciary, and in principle, you're spending somebody else's money. So if you're a fiduciary on a plan, you're spending the participants and beneficiaries' money. So you have to have some basis, some reason, some process that you go through in evaluating the solutions that you've selected as a provider, the retirement plan provider. Most often, lowest cost does not mean that it's the best solution. And the regulations don't specify that you have to find the lowest cost provider. There's a lot of misunderstanding out there, and a lot of things are promoted about being the lowest cost provider. Well, the lowest cost is not always the best solution, but the fees should be commensurate with the services that are provided. So it's important to know what your business needs, what your employee base, what their needs are, what are the capabilities for employees receiving electronic notice. A number of factors come into play. But the monitoring should be something that's ongoing, and always aligned with the business objectives. And one of the things that we've noticed over the past 10 years is there's been a surge in the number of firms that are holding themselves out as fiduciaries, basically saying that if you hire them, they are relieving you, the employer, of all of your fiduciary duties. First of all, there is no legal way that they can do that. At the end of the day, as an employer, an adopting employer, your number one responsibility is to monitor the plan, the service providers. You cannot outsource that. You can hire coaches. In fact, I refer to those types of fiduciaries as a fiduciary coach. Probably the best analogy to put it in context is really around like when you have your tax return prepared. If you go to a CPA, have your tax return prepared, the CPA prepares the tax return, but you are the taxpayer. When you sign that tax return, submit it to the IRS, you're responsible for everything that's in it, not the CPA. If the CPA made a mistake, you may have some recourse against them, but ultimately, whatever is on the return, you're responsible for. The same goes true with fiduciary responsibilities under a plan. There are some things you can do to mitigate some of that liability. You can shift some of those responsibilities over to a service provider, but at the end of the day, first and foremost, you have a duty to monitor the plan, make sure that the benefits, the features and so forth that are in the plan are what's needed for your employee base, for your business, and you've got a structured process that you go through at least every 3 years to reevaluate that process. And then the final step is really around selecting service providers. Selecting service providers, specifically when you're talking about, and this is one of the terms we mentioned early on, but it's a pool plan provider. So with a pool plan provider, essentially that's going to include, most of the time this is bundled up into a single arrangement, but you have the third-party administrator, which administers the plan. So they determine eligibility, they're making sure that they follow the terms of the document, they're preparing the 5500, doing the compliance testing, all of those administrative functions that go on to making sure that the plan is complied with the IRS regulations so that it maintains its tax qualified status. That's the primary responsibility of the administrator. The record keeper, on the other hand, keeps records. Sometimes their systems will calculate eligibility. Most of the time we do see that in record keeping systems. So they're maintaining participant balances. Participants can log in, make trades, move money around, request loans, distributions. Those types of features are typically managed at the record keeper level. And then we have an ERISA 316 fiduciary. And this is one of the fiduciary responsibilities that can be offloaded from you, the plan sponsor, or you, the adopting employer, to your service provider. And one of the big advantages of a pooled employer plan is the fact that you can offload that responsibility. So what that means is if a participant requests a distribution, you, the employer, are not having to deal with it. All of that's taken care of by your provider. They take care of all the details. If there are, it's their responsibility, and I say they're being the 316 fiduciary, it's their responsibility to monitor the plan, make sure contributions are going in timely. So those are the responsibilities. It's an administrative fiduciary. Essentially, is what ERISA 3 Section 316 specifies. It's ministerial administrative functions that are fiduciary in nature. And then also, so a lot of times those three functions are bundled together. The pool plan provider is going to bundle those together. The trustee, I know for the pooled employer plan that we run, we use a trustee. It's already designated in the document, and most of the time you're going to see that in your adoption agreements as well, where the trustee is not discretionary for the adopting employer to make a determination or decision on who the trustee is, but there's a lot of flexibility in PEPs. So just be aware of some of those things that are out there relating to trustees, and be mindful of who the trustee is. And someone that you have confidence in. Then next is the investment manager or fiduciary. The investment manager or investment advisor. And let's clarify what these terms mean. So an ERISA 321 fiduciary is someone that can meet with employees, educate them about the investment options, do primarily participant education. They are not taking responsibility for the investments of the plan. An ERISA 338 fiduciary, on the other hand, does contractually take on 338 responsibilities. So if something goes sideways with the investments, if there's any particular issue relating to the investments, the 338 advisor or manager is the one that has taken on those responsibilities. Keep in mind, this is where there's a lot of misleading information in the marketplace that you as the adopting employer or the employer cannot relieve yourself of responsibility by hiring a 338. You can offload the 338 responsibilities. So now that's part of your service provider that you've hired, but you still have a responsibility to monitor and make sure that you're tracking, annual meetings, make sure that you're putting together documentation and so forth, reviewing the investments and so forth. But you do have a duty to monitor that cannot be offloaded to someone else. But it's important to understand the distinction, especially when you're dealing with a PEP, because and this may not be indicative of some of the providers out there. Some of them are what I call captive. So they're requiring that you use all of their bundled services, whereas some providers out there have a little bit more flexibility. If your advisor that you've worked with, we had a case recently, they were very adamant about sticking with their advisor. They didn't want to change. They'd had a great experience with them, did a great job meeting with employees. So in that situation, that advisor could continue to function as a 321 fiduciary because they're not taking on the investment management responsibilities. The PEP actually has a 338 fiduciary already attached to it, so they could work with their local advisor for employee education and so forth. So a lot of options there. And like I said, not all providers are open, to this level of flexibility, but it is worth exploring what the options are and use that in your process, in your decision-making process. Because one of the things that we've seen with PEPs, and we discussed this with our ERISA attorney early on, she said the main thing to keep in mind and what they're seeing across the board is, in the misconception, I believe, in the marketplace is PEPs are supposed to be more cost effective than a standalone 401k solution. In some cases, that is correct, especially when you're talking about audit, being able to shift that cost, or not have to bear that cost as a standalone plan sponsor. But utilizing a PEP, it does give you the option of offloading some of that cost. But at the end of the day, a PEP should really give you enterprise level capabilities, features, and so forth that you can roll out to your employees so they have a better experience. They have more tools, resources that are available to them than they would otherwise in a standalone plan. So those are really some of the main things to keep in mind as you're evaluating the process. So to recap, the most important, and this is the way that we think about it, and when we do webinars like this, is really try to encourage everyone, because retirement plan benefits can be a substantial expenditure for any business. So why not ensure that those expenditures optimize the utility to your organization? It should provide some utility back to the organization, whether it means that your employee turnover is going to be less, it gives you a way of recruiting better talent. So whatever the strategic business objective is, that's the starting point. So identify what's important to you, reevaluate those on a regular basis. And as your objectives change, then make sure that you're building a plan around those objectives. Sometimes this may mean engaging an expert. A lot of times we see it, and it's typical where a lot of retirement plans are really marketed through financial advisors. They play a very important role in the process, but a lot of times most of them don't have the experience of drilling down into some of the details that you need to get into to really craft a plan around what's important to you and your strategic business objectives. So sometimes it may mean bringing in an expert that works in conjunction, with your advisor or other service providers. And then also be mindful of the fiduciary duty. This is absolutely critical, whether you're part of a PEP, MEP, standalone 401k plan, whatever the case may be, there's a responsibility there to monitor, make sure that you know what's going on, and that responsibility, some of those fiduciary responsibilities can be offloaded, but at the end of the day, the most important one is the fact that you are ultimately responsible for monitoring the plan. And lastly, providers should be selected based on all the other criteria. So if I've got a business objective, I've built a plan, created the plan design around that, I know what my fiduciary responsibilities are. Then and only then should you start looking at the service providers and bringing them together to assimilate the team that's needed to make this work. So that's a very critical piece of this is really around the payroll and how does the payroll integrate with the pool plan provider and the PEP. Because if you're offloading through the PEP, the 316 fiduciary responsibility, payroll integration is an absolute must. And making sure that you've got a good payroll provider that can integrate and then that'd be part of the team as well. With a pool plan provider working in conjunction with each other to make sure this unified experience, then that's really when you've built the optimal pooled employer plan and you've offloaded some of those responsibilities and you've got a plan that has enterprise level capabilities that a lot of times as far as what the employer and employees are paying can be, in some cases significantly less expense-wise than what you're currently paying, especially if you're currently in an arrangement where it does require an audit. So really the take away this slide here, because that's the critical piece. Start with the business objectives, build a plan, know your duties, and then lastly, select the service providers. Don't start off by selecting service providers. Build the process around what's important to you for a business. So what is a fiduciary's primary responsibility? I've harped on this several times. So this is really our last poll question. So what's a fiduciary's primary responsibility? And that primary responsibility is a duty to monitor. There's no legal way that can be offloaded. Thank you for your time today. And John, do we have questions?
Nothing is coming yet. You want to just hang out for a minute here? We'll see if anything comes in.
Okay.
Got 3 more minutes.
Well, I guess either we answered all the questions or we confused everyone, one of the two.
I found it very informative. So if you didn't confuse me, I think you hopefully gave some good information out to people. And I think Leah might have a couple items to close out too here.
I do. So I can take it back over if nobody has any questions. All right. Well, thank you again, Richard. That was, like John said, very informative. We thank you for your time today and taking the effort to educate us and give us some really helpful information. For everybody attending, as you exit, you will receive a link for a survey in the tab that open with Zoom. We love your feedback if you have a minute to fill out the survey. And your certificates with activity IDs for credit, as well as the webinar recording, will be sent early next week. If you have any questions about the presentation or for ERISA, please reach out and we'd love to help with that. Otherwise, have a wonderful day.